Hi, everyone, and welcome to today's webcast, Building ETF Portfolios to Generate Alpha, sponsored by Chaikin Analytics. A copy of today's presentation can be found in the green folder at the bottom of your screen, and we also have a brief survey which can be accessed from the teal folder. Our speaker today will be taking advisor questions. Please type in any of your questions in the box to the right of the slides. We're going to get to as many of your questions as possible. A replay of this webcast will be made available. All registrants will receive replay information by email 24 hours after the webcast ends. And with that, I'd like to introduce today's speaker, Marc Chaikin, founder and CEO of Chaikin Analytics. After 50 years on Wall Street as a trader, stockbroker analyst, and options trader, Marc founded Chaikin Analytics to deliver proven stock analytics to investors and traders based on the Chaikin Power Gauge, which is a 20-factor alpha model proven effective at identifying a stock's potential. Chaikin pioneered the first real-time analytics workstation for portfolio managers and stock traders, which is now part of the Thomson Reuters Institutional Workstation. He also developed computerized stock selection models and technical indicators, including Chaikin Money Flow, which are now the industry standards. So with that, I'm going to turn it over to Marc, and then we'll dive into one of our poll questions. Marc?
Thank you, Stephanie, and welcome everybody. This is really a historic day for the markets. We've got the Dow Jones averages at record highs, 22,000, along with the S&P 500, the NASDAQ, and the Russell 2000, and all that without the participation of energy stocks or retail stocks, which plays into one of the themes of this presentation, that you need to be selective both in terms of sector and group analysis, and certainly when you're looking at individual stocks if you create individual stock portfolios. But a little bit about me. I've been on Wall Street for 50 years. For 45 years, I've been using technical analysis along with fundamentals to create rules-based investment strategies. I think that's very important. I started out with a firm called Shearson Hamel in 1966, the day the bear market of 1966 ended. So for the first 2.5 years of my career as a stockbroker, every day was an uptick. And then the bear market of 1969-70 surfaced, and I realized that now, no matter how good your fundamental research was, your stock selection, your asset allocation, in a bear market, you needed other tools to help protect client assets. And that's when I began a lifelong research project into technical analysis. And many of you know me for the indicators that Stephanie mentioned, Chaikin Money Flow and Chaikin Oscillator being the primary ones. What we're going to be talking about today is all at its heart around a 20-factor, fundamentally driven quantitative model. After the financial collapse of '08, I decided to come out of retirement to build a model for both high net worth individuals and advisors, which basically gave them an independent fundamental view of a stock, unbiased as to investment banking relationships or subjective judgments, and that is, in fact, the Chaikin Power Gauge rating. Along the way, I headed the options department at a good regional firm called Tucker Anthony and R.L. Day, so I'm very familiar with option strategies. I know a couple of you were with us at the Options Industry Council conference in Tirana, but my primary focus is to share with you what I've learned working with institutional investors over a 50-year career on Wall Street. I've been mentored by some of the smartest and most successful money managers. Some were colleagues, others were clients. They all had different styles. And what I learned from them is embodied in the Chaikin Power Gauge rating, this 20-factor model. It's the culmination of my life's work. And we're absolutely committed to creating products around this to help the advisor be more productive, have richer conversations with their clients, and basically add alpha. So with that, I'm going to turn it over to Stephanie for a short poll question to get us started.
Great. Thanks, Marc. So, folks, we have a poll for you right on your screen. If you would, please go ahead and answer the question directly on the screen, and we're also going to show you the results in just a minute. And the question is, what are your biggest concerns for 2017? A topping market, rising interest rates, regulation changes, or client communication? So what are you finding are your biggest concerns for 2017? Go ahead and answer that question right on the screen. I'll give you a couple more seconds, and we'll go ahead and take a look at our answers here. So Biggest concern, 61% a toppy market, 23 rising rates, 14% regulation changes, and 2.9% client communications. Marc, I'll turn that back over to you.
That's great. I feel as if we've rigged the answers because this plays right into the first part of our conversation here today. A little bit of validation of Chaikin. We launched our first commercially available product in January of 2011. We've been reviewed 2 or 3 times by Barron's, who called us in their last review one of the top 2 quantitative sites on the internet. And we've also been embraced by hedge funds like Paulson and Soros and Fidelity Management, as well as recognized market commentators like John Malden at Malden Economics. So a lot of validation of the intellectual property that we're going to be looking at. Now, let's start off with a sort of whimsical question, but one that's really serious. Do President Trump's tweets have your clients spooked? I know that you're professionals, so you probably dampen down the emotions. Well, the reality is these tweets can often be an opportunity. Here we've got a chart of Boeing, and that yellow arrow shows when Trump tweeted negatively about Boeing on December 6th. It created a one-day sell-off about 1%. And look what's happened subsequently to that. Boeing has made a new high, and this has happened with many of the stocks that Trump has tweeted about. So part of what we believe in is you've got to take the emotions out of the decision-making process, that overreactions create opportunities, whether you're using individual stocks, ETFs, sectors, or what. The tweets are a distraction, and you've got to get beyond that. Now, what we think the advisor's main concerns are was validated by your poll results. Stock market volatility and direction, asset allocation, sector strength and weakness. We get a lot of feedback from our advisor clients who subscribe to Chaikin Analytics, and this theme keeps coming through. So it's important to realize that volatility is not a recent phenomenon. Every year the market experiences a significant correction. Over the last 30 years, the annual correction has averaged 14%. Now, that's skewed by a couple of 3 bear markets in there. But in reality, those who stay the course were rewarded. And as advisors, you know that one of your jobs is to keep clients comfortable, to hold hands, and to stay the course with whatever strategies you use. But I'd like to quantify this a bit. This slide puts pullbacks into perspective. Since 1945, there have been 75 declines of 5 to 10%, roughly 1 a year. They tend to last a month. Think Brexit in June of 2016. But the interesting thing is you recover back to new highs within a month. So these 5 to 10% corrections are actually your friend. But then go down to the bottom line. How many declines of 20 to 40% have there been? There have been 11 of them in 72 years. So that means if you're constantly looking for market tops and a bear market to surface, you're missing out on enormous opportunities. Now, these are painful, and we've got tools to help you sidestep part of that, but I think you realize that clients don't pay you to be in cash, but there are ways to be defensive using options to create some cash reserves to take advantage of declines, and we'll see how we play into that theme in a moment. Now, it's important to focus, and we all realize how important that is in our daily practice in dealing with clients and dealing with the information that comes at us. So here's what we think advisors should be focusing on in 2017. The trend of corporate earnings, trend of interest rates, sector and group strength and weakness, which is at the heart of today's presentation, and stock selection if you choose individual stocks and create portfolios. Now, I love this graphic from Bank of America Merrill Lynch. So going back to the beginning of the bull market in March of 2009, from 2009 through 14, we were in the most bullish scenario. Falling interest rates, rising earnings. We were comparing earnings, obviously, to the 2008 collapse and the collapse in earnings. And then in 2015, we went into a more challenging period, which was declining rates and declining earnings. We had 6 straight quarters of year-over-year declines in earnings. Remember what was being called the earnings recession, and many analysts on CNBC were saying this is going to lead to a bear market in stocks. Well, that never happened. And in 2016, we went into another bullish scenario here in the upper right, which is rising rates and rising earnings. And that's the period that we're in now in 2017. The Fed has said they're going to raise rates 3 times. We've had 2 straight quarters of year-over-year increase in corporate earnings, so we're out of that earnings recession. And people who are calling this a Trump bull market, I think, have it wrong. This is really an earnings-driven, interest rate increase-driven bull market, aided by stronger numbers coming out of Europe and Asia. So this is really a healthy environment. Employment is robust. Spending power is there, whether consumers decide to spend it or not. And most importantly, confidence is up. Small business confidence is very high subsequent to the Trump election. And small businesses create 95% of the jobs in America. So in our view, the rally is on strong footing, and today's action is proof of that. I mean, who would have expected 2 weeks ago, with all the press, hand-wringing about the supposed dysfunction of the Trump White House, that we'd be looking at new highs in the market after his first speech to Congress? I certainly, if you had asked me based on emotion, would have said no. So if we're in a rising interest rate climate, do we want to be focusing client assets on fixed income? So here we're looking at the TLT, the 20-year Treasury ETF. A lot of advisors use this to allocate money to the bond market. We can see that it peaked in July of 2016, meaning that yields started moving up. And long before the election, bond prices were getting slammed and yields were up. Subsequent to the election, that trend continued into late December, early January, and we've gone sideways ever since. Jeffrey Gundlach, famous bond money manager and guru, talked about a trading range in bonds now. But in general, if the Fed is telling you there are 3 interest rate hikes coming in 2017, and the first one is likely to happen here in March based on what we're reading in the press and Fed fund futures, do we really think that bonds are the place to be? And my response would be no, that we're going to see new lows in bonds and new highs in yields. So if bonds aren't the place to be, then it's got to be equities. So here's a 1-year chart of the S&P 500. I've chosen the equal-weighted S&P ETF. How many of you are familiar with the RSP from Guggenheim? It's got about $8 billion in it. It's maybe 1/10 the size of the SPDR. But the reason I put this up is that price-wise, it tends to mirror the S&P 500 and the SPDR ETF. And you see that we've been in a well-defined uptrend channel that we've now broken through on the upside. Now, this is causing a lot of analysts to say we're very overbought and you've got to take money off the table and valuations are too high. Well, 2 things to take away from this chart. Number 1, Chaikin money flow, which measures institutional buying and selling and has been in the marketplace for 35 years. It's on Bloomberg, it's on Reuters, it's on all of the online brokerage sites, stockcharts.com. So it's a widely followed indicator. It's very, very strong. Institutions continue to buy the market, and they're using ETFs like the SPDR and the RSP to allocate money to equities. Now, what I find interesting is the relative strength chart. We compute the relative strength of the RSP, which is equal weighted, which means that Amazon and Netflix and Google, the FANG stocks, have the same impact, no bigger or smaller than the 500 smallest stock in the S&P. And typically, when the RSP is outperforming the S&P, which means our relative strength indicator here is green, that's a very healthy sign for the market. It's the old saying in Wall Street back when I started, when the generals are moving, you need the foot soldiers to follow. Back then we had General Motors, General Electric, General Telephone, and so forth, the big companies. What we see is that through today, small caps, as summarized by the relative strength of the equal-weighted S&P to the cap-weighted SPDR, have started to underperform. In other words, Facebook, Amazon, Google, outperforming the small cap stocks. In general, that's not the healthiest sign for the market. You want broad-based participation within the S&P, in the Russell 2000, but that's just a temporary warning sign. Now, we've had a 25% rally since the bottom in February of 2016. A lot of people are now concerned about the market, but here's a chart from Citi Research, from Citibank, that shows what happens after a 25% rally. 75% of the time, the market moves higher over the next 12 months. So your biggest concern based on the poll is the market toppy here? Well, the answer is perhaps on a short-term basis, but 25% of the time, 50% of the time, the market goes up an additional 25%. 75% of the time, you're higher 12 months out. So the probabilities favor a continuation of the rally. That's also borne out by another statistic, which is when you start the year with 2 up months, January and February, 25 out of 27 times you continue higher for the balance of the year. So the historical patterns support the notion that the market is likely to move higher for some good part of 2017. Now, if you believe that we're in a rising interest rate environment, it's important to know what sectors do well and what sectors do poorly in a rising interest rate environment. And in a rising interest rate environment, which is typically triggered because the economy is healthy, here are the sectors that outperform, and this is based on over 50 years of market analysis. Financials, industrials, technicals, energy, and materials. The sectors that do poorly in a rising interest rate environment sort of make sense. These are the defensive, yield-oriented sectors: utilities, telecom, healthcare, and consumer staples. Consumer discretionary is sort of the outlier. So let's see if reality has matched history. And we do that by looking at our sector performance module in Chaikin Analytics. We've sorted the 10 select spider sector ETFs, the large cap breakdown of the S&P 500, by 3-month performance, and we see, in fact, reality is matching expectations. The leading performers over the last 3 months: financials, technologies, materials, doing better than the S&P, industrials right underneath, and the weaker ones: healthcare, real estate, consumer staples, and utilities. Energy is the outlier. It should be moving up. It hasn't been. In fact, as we get into our power gauge rating, I'll tell you that a lot of oil and gas exploration stocks have seen their power gauge rating turn bearish over the last 2 weeks, meaning the fundamental factors are not lining up well. And a company called EOG is an example of that. We did see some strength here in the utilities over the last 2 weeks, and part of the reason is interest rates have dropped from 260 on the 10-year Treasury down into the 230 area. So people are betting that maybe we won't see these big Fed rate hikes, but I'd rather go with what the Fed's telling me than with what people are thinking. So one of the big problems that we've learned is that advisors, just as all of us, are overwhelmed by a flood of information. You've got to keep up with client portfolios. You've got to keep up with macroeconomic trends. You want to be talking to your important clients, but you also want to have enough time to prospect for new accounts. So you need to be productive and efficient, and Chaikin Analytics solves that problem with our Chaikin Analytics workstation, both for iPad if you're mobile friendly and for desktop. And our solution basically saves you time and increases productivity, and as you'll see in the balance of this webinar, it helps you generate alpha. So we believe in a disciplined methodology. At the top of the pyramid is the Chaikin Power Gauge rating, our 20-factor model. The reason I'm focusing on this is that we evaluate ETFs right now based on the 20-factor quantitative model for each of the constituents within an ETF. We also think sector ratings are very important, and I'll show you how we do that, and it's a unique approach. At the bottom of those 2 technical indicators, I talked about combining technicals with fundamentals. This is particularly important if you do bottom-up stock picking for clients. Chaikin Money Flow and Chaikin Relative Strength, you've seen examples of both. And then for more active managers, we have 6 pairs of buy and sell alerts within the system. But the key is a disciplined methodology. It's focused, it works, and It's based on this very simple display, the Chaikin power gauge rating. But don't confuse simple with simplistic. What I like to say is that the power gauge rating is like a Chevrolet with a Ferrari engine under the hood. It can also be your GPS during earnings season because a lot of clients are nervous about volatility surrounding their holdings during earnings season. And the power gauge rating can help you know with a high degree of reliability which stocks are likely to outperform or underperform analyst estimates. So here are the 20 factors in the model, again, based on working with institutional investors over a 40-year period, seeing what they looked at to make investment decisions. This model has worked since we released it in January of 2011 because it's based on the way the market works. These 20 factors are what big institutions look at every day before they make buy and sell decisions. Now, obviously, they don't look at all 20. Warren Buffett would look at valuation metrics like free cash flow and price to sales. Someone like a Jim Cramer or a hedge fund manager is interested in earnings and earnings surprise and earnings estimate revisions. These are big drivers of short-term stock price movement. 85% of these factors are fundamental, only 15% technical. And there are some interesting factors in here that are not in typical quantitative models, like insider buying and short interest. And industry group relative strength is a very important factor. So it's an eclectic model. It finds a lot of different ways to like or dislike a stock. It's got an ideal time framework of 3 to 6 months, but very often there are rolling 3 to 6 month time periods. And we've proven in indices that we've created for NASDAQ and in unit investment trusts, the first trust is rolled out, that the time frame for these indicators and their predictive value can extend out to 12 to 15 months. So these are definitely not for short-term traders, although short-term traders use them because if you're going to put on a swing trade in a stock, you want to be positioned with the fundamentals, not against them. But these are meant for investors with an intermediate to long-term time horizon. Now, here's what the power gauge ratings did in 2016. This is based on the Russell 3000 universe with equal weightings in each bucket, so it's not just picking the tails of the distribution curve. The 428 very bullish stocks based on the Chaikin power gauge rating were up over 32% in 2016. The very bearish stocks were up only 9%, with the Russell itself up 15. In 2015, when we really had a bear market in energy stocks and small caps, the very bearish stocks in the Russell were down 18%. Imagine if you could avoid those in client portfolios and focus on the very bullish stocks. Now, we have two other validation points. We've created 3 co-branded NASDAQ Chaikin indices based on their large cap, small cap, and dividend achievers index. They were rolled out in April of 14. They rebalance once a year. They're all outperforming their benchmarks. And look for Chaikin branded exchange traded funds shortly, sponsored by a major insurance company, because the indices have proven themselves, they've done their job, and they're going to be the basis for ETFs coming down the road over the next 4 months. We also have 6 unit investment trusts with first trust portfolios. There's about $50 million being managed there. So there's real world validation for the performance numbers that we're looking at. Now, before we get into ETFs, let me give you an example of 2 patterns that are really important if you're a bottom-up stock picker, but also because they validate the Chaikin discipline methodology. We have a pattern we call classic Chaikin bulls. The power gauge rating, which is our fundamental rating, is bullish. Stock is outperforming the market, which means that the market is agreeing with the model, very important. And Chaikin money flow, which measures institutional buying, is green or positive. Here's United Health, largest healthcare provider in America. Power gauge rating is at the bottom of this 1-year chart as a red, green, yellow ribbon. And United Health has had a bullish power gauge rating, except for this period leading up to the election, for over 18 months. And we also show on the screen the last 4 earnings reports, and we color the icon red, gray, or green to tell you whether the company underperformed or outperformed. Now, companies that continually outperform analyst expectations tend to work their way higher, especially when institutions continue to buy those stocks. So this classic bullish pattern has resulted in United Health going to new highs even when the healthcare sector was lagging the market. It was making new highs. Healthcare is now catching up a bit as people are getting more comfortable with the Trump policies in the healthcare space. Now, we have a pattern that we call classic Chaikin bears. This is really important if you're managing individual stock portfolios or if you're talking to clients about individual stocks. Remember, your account is not the only account your client has. Investment News magazine did a study, and they asked advisors whether they thought their clients had another account, and 75% of advisors said no. When they asked the clients that question, 80% of them had another account. And it's an account that they may call play money, but it could have serious dollars in it. So for those people, if you're talking stocks, you want to be aware of which stocks have negative potential. And Chipotle is our poster child for a stock with a bearish rating at the bottom until just recently, underperforming the market. Look at all that red, negative money flow. Institutions continue to sell the stock. And the reason we have the red circle at the top is that the power gauge rating on Chipotle turned bearish 6 months before this chart begins at a price of $6.90 on the way down to $3.80. So playing defense, we can do it with sectors. We can do it by avoiding stocks that are likely to implode and destroy portfolio results. And this is an example. Now to the heart of the presentation, using sectors and ETFs to allocate client assets. What I like to do is start with the 10 select SPDR sector ETFs, and I'll show you what our power bar rating is. I like to drill down on strong sectors to see what stocks have the best ratings. A, as a sort of sanity check, and B, because you can add additional alpha over and above allocating client assets toward the ETFs with the best potential by also buying some of the stocks with the best potential in those ETFs. So we think ETF sector and group strength and weakness is really important. There have been white papers from Zacks, from William O'Neill, Investors Business Daily, Standard & Poor's, done over the years that show that if you invest in strong sectors and industry groups, you've got a tailwind and your long side profits are stronger. On the other hand, if you try to bottom fish, invest in weak sectors, you're facing headwinds and they really create problems. The retail sector would be an example of that right now. Obviously, energy in 2014 into 15, another example. They do lend themselves, if you do use options, to hedge strategies or put purchases if you're speculating for clients. But the key is that they enable you to be flexible. And that's really the key to the Chaikin methodology, putting the wind at your back. There's an old expression in sailing. I am not a sailor, but my wife Sandy, who works here in the company, is. And it says that you can't direct the wind, but you can adjust your sails. And in a sense, that's what Chaikin Analytics is all about, giving you the ability with a proven, disciplined, objective methodology to adjust your sails in terms of client asset allocations. So here's a performance chart of the 10 select SPDR sector ETFs. Again, we're looking at the large cap sectors, and we're going to address the issue of what if you want to diversify into mid and small cap stocks in strong sectors in a minute. But financials, industrials, technology, all beating the S&P. Consumer discretionary is a bit of a red herring. Why? Because Amazon is such a big component of consumer discretionary. Retail stocks are going down. Restaurant stocks in the main have been poor. So consumer discretionary is a tough sector in terms of asset allocation. You're basically making a big bet on Amazon if you buy the select SPDR sector consumer discretionary. Now at the bottom, real estate, consumer staples, utilities, healthcare, and energy. We've had a big rally in consumer staples, as you'll see, and part of the reason is Procter & Gamble is 14% of that index. You need to know these things, and we very quickly point you in that direction. So Procter & Gamble has an activist investor who's weighing on them. It's Nelson Peltz from Trian, and the stock has had a huge run-up, ironically, right after Goldman Sachs put out a sell recommendation on Coca-Cola and Procter & Gamble. Nelson Peltz came in, And that's had a big impact on the consumer staples performance. Now, here's how we rank sectors. What you're looking at are the 10 select spider sector ETFs, and we rank them by something we call the power bar. This is something I learned from one of my mentors, George Douglas at Drexel Burnham, who did the original research in earnings surprise and earnings estimate revision. He taught me that you could roll up earnings surprise factors for individual stocks and create sector and group rankings based on the earnings surprise of the individual stocks. We've done that here with our power gauge rating. Notice right at the top, the financial sector, these are the large cap stocks in the S&P 500, 43 stocks with bullish ratings, none with bearish ratings in our fundamental model. Now, utilities jumped up in the list from near the bottom because interest rates have backed off, and there's been some bargain hunting, and yield-oriented investors have gone back into utilities. I'm skeptical of that because the Fed has told us they're going to raise rates 3 times this year. At the bottom, consumer staples and energy along with real estate, that's what you'd expect. So let's look at that strong sector, the XLF, the financial spider sector, financial ETF. What you see on this one-year chart is on the left, the strongest stocks based on our fundamental model, the power gauge rating on the left. And then you see a price chart. We don't have ETF ratings yet. I know a number of you have asked questions about when they're coming. This has been a very challenging analytical problem. We hope to have them by the end of May. That's our goal. I know you've been waiting for them for a long time. Apologies for the delay, but this is such an important piece of intellectual property that we want to make sure it's absolutely ironclad, back-testable, and so forth. But you still can allocate the strong and weak sectors based on the power bar, the fundamental potential. And you can also look at the chart. So if we look at the chart, 2 takeaways. Here's our relative strength indicator. The financial sector, particularly the large cap stocks, started outperforming the market back in late August. How do we know that? Because the relative strength indicator went from red to green. Very visual. We're not adding to the information overload problem, we're solving it. Instead of looking at a table of numbers, it's a visual, it's powerful, and it doesn't change that often. And notice that the financial sector, the XLF Spider ETF, was going sideways when the market was dropping for 9 straight days into the election. Actually didn't even make a new low. And then, of course, once Donald Trump won the presidency, the financial sectors, large, small, and mid, all exploded based on 2 things. A rollback, expected rollback in regulations. We all know how onerous FINRA and SEC regulations can be, and they're particularly costly for the banks, even more so for the small cap names that have done so well, and the insurance companies. But the key is that there's persistency in group strength, and that's important to sector allocation. You should be comfortable that if you're looking at the right tools, you can allocate to sectors for 6-month windows that may roll and move forward. So we still have the financials with very positive money flow in this ETF, outperforming the market. And by the way, for those of you who think the financials are very toppy here, be mindful that we're still 25% under the all-time highs in financials and in energy stocks that were reached in 2008. So whereas 8 of the 10 sectors in the S&P have gone to new highs, financials and energy have not. So there still may be big upside. Now let's look at some of the stocks in the XLF. JP Morgan, notice that the power gauge rating turned bullish in April. That's what we want the ETF rating to be able to do for you, and why we're taking our time and a lot of intellectual thought going into it. But beginning in April, the power gauge rating said JP Morgan was attractive from a fundamental point of view. The real move started in August, even ahead of the XLF, when JP Morgan started outperforming the market. And then look at the money flow. Institutions, long before the Trump victory, which brought expectations of inflation and rising interest rates and deregulation, JP Morgan was deemed valuable. A lot of these bank stocks were selling under book value, particularly some of the brokerage stocks like Goldman Sachs, the investment banks. And then, of course, with the Trump victory, you broke out to new highs, and you've had a series of positive earnings surprises. Jamie Dimon has said, I can work with the Trump administration. This is a very positive chart. The question is, do you want to buy it at the top or wait for a pullback? My answer is always wait for a pullback. So this is one of our 6 pairs of buy and sell signals, which came back here in January, under 85, giving you a nice opportunity to get into the stock before about a 7% move. Now, Goldman Sachs, very similar story, except it started moving up even before the election in a big, big way, and outperforming the market with positive money flow. Very similar chart to JP Morgan. It's no surprise that there are 4 key Trump administration slots filled by ex-Goldman Sachs executives. This is not new. We've seen this before. That doesn't mean they know more than you or I do, but it doesn't hurt. So large cap financials clearly doing well. But as those of you know who use ETFs, large cap is not the only answer. So we give you the ability in our list manager to drill down to various industry, sector, and style-based ETFs and see them ranked by the power gauge rating. So here in the financial sector, you've got a number of regional banks, the KRE index, the KBE, you've got down at the bottom an insurance index. Now, insurance stocks have done well, but they've lagged the major banks and some of the regional banks and thrifts, which have had some really big moves. But knowing which ETFs have the stocks, the constituent stocks with the best power gauge potential, does 2 things for you. It enables you to zero in on ETFs that you may want to look at more closely by looking at the price chart. It also gives you the ability to drill down and see what stocks they own, because if they're performing well, then they may have a great stock selection methodology, whether it's based on an index or it's discretionary, it doesn't matter. So let's take a look at some insurance stocks. This is that ETF, the IAK that we looked at, which is an insurance industry ETF. Notice how many bullish stocks there are on the left navigation bar in the industry. Notice how it's been outperforming and making new highs. So there are opportunities in small, mid, and large cap financials. In this case, Progressive Corp here is a stock that we've recommended in our weekly market letter as a stock of the week. This is your favorite ad character flow with these great commercials for Progressive Auto Insurance. Power gauge is bullish. It's been outperforming the market. A lot of institutional money is flowing into it. It's an example of another sort of mid to large cap insurance stock that may have more room on the upside. So you can buy the ETF, the IAK, or you can look for some of the strong stocks in there. Now, we also have a stock screener. There are a lot of opportunities in small and mid-cap financial stocks, particularly in the insurance sector. So I ran this screen yesterday. I selected an industry at the top called insurance. I want the power gauge rating to be very bullish, so I'm in that bucket that was up 32% last year in the Russell 3000. And then I'm looking for small and mid-cap stocks with strong money flow and relative strength. Very disciplined, focused approach. We started out with 126 names. We ended up with 12 that met our criteria. And I've circled one called Radian Corp. This is a mortgage reinsurance company. And part of the reason I like that, and I've recommended it in my weekly market letter, is Doug Cass from Seabreeze Partners is very bullish on the stock. He's a very smart investor, does good research. I wouldn't rely on him. I'm relying on the power gauge, but it stuck in my head when I was reading an article on one of Jim Cramer's websites that Doug Cass was bullish on Radian. And here's what the stock looks like. The power gauge rating turned bullish in March of 16. It was underperforming the market, and the stock really did nothing. That's why I love combining fundamentals with technicals, because when a stock is outperforming the market, as Radian did back here in July and continues to do, and the model is bullish, you have the market agreeing with the model. Very important. No matter how good your fundamental research is, whether it's conventional, whether it's quantitative, whether it's earnings driven, if the market disagrees with you, that is dead money at best and a disaster in the making at worst. So I like to see a combination of strong fundamentals. The power gauge does that heavy lifting for you, and the power bar in the ETF space, and then combine that with relative strength and money flow. And here's a stock, when everything had kicked in back here in July, Radian was trading at 11.5. It's peaked here at 20 recently. And I think this is proof positive of how powerful a disciplined approach can be. This is not cherry-picked. We've recommended the stock about a month and a half ago after that buy signal as a bullish stock of the week. So let's go back to that weak consumer staples sector and end the webinar by showing you how you can play good defense. Because very often good defense leads to good offense. So here's the consumer staples select spider sector ETF, the XLP. Now notice that it started underperforming the market here in July. We call that a bearish personality change. And there are a number of well-known names that have had bearish ratings, including some of the beverage stocks like Monster Beverage and Coca-Cola and Molson's and Bud and so forth. Some of the cosmetic stocks like Coty and Estee Lauder. A mixed bag of consumer staple stocks. Now you might ask, well, if it's been underperforming, why is that big rally taking place? Well, A, the rally didn't take it to new highs, and B, as I said, part of that rally, a good part of it, is the huge move in Procter & Gamble of over 30% based on an activist investor taking a large position, Nelson Peltz, in Procter & Gamble. So you've got to be aware when you're trading and using ETFs for client asset allocation, what are the drivers of that ETF? If you're dealing with the select spiders, the large cap stocks play a big impact. Obviously, if you're in the Russell 2000, IWM small cap, less so, although that is a cap weighted index. So let's look at a couple of the stocks in the XLP. Monster Beverage, as we've said, the power gauge rating turned bearish in mid-August. The stock was trading at around 51. It started underperforming the market in October with the stock at about 48. And it's basically been dead money. And Coca-Cola happens to own a big piece of this, and Coca-Cola looks similarly disadvantaged. So it's a stock that you want to be out of. It discourages you from wanting to be in beverage stocks if there are other stocks in the group with similar configurations. And then Coty, this is a $15 billion market cap company. Power gauge turned bearish basically in May and stayed bearish. The stock started underperforming the market. Money has been coming out of it, and it's been making new lows. And the same was true for Estee Lauder until their most recent earnings report, when it appears that they may have stemmed the bleeding. So sector analysis can lead you to group analysis. So soaps and cosmetics, beverages have been very weak, consumer staples, the cereal stocks, and they can help you avoid problems and talk more intelligently with your clients about individual stocks. Now here's a bonus because I want to show off the most recent creation of Chaikin Analytics. It's an ideas engine that I'm absolutely excited about that we've bundled into our product for the time being. We're looking at Under Armour. It's a well-known name. There's speculation that they may be having problems because Steph Curry from the San Francisco Warriors, the Golden State Warriors, not having a good year. They paid him a huge contract. But the bottom line is you don't have to know any of that. Power gauge has been bearish. It's been underperforming the market. And look at all this institutional selling. And right ahead of this negative earnings surprise here just 2 weeks ago or 3 weeks ago, we had sell signals in the stock. So opportunity to get out if you're stuck in a position. Knowing that the apparel stocks is weak is very important. But what if you like the apparel sector long-term and you're looking for a swap idea? Well, that takes us to our stock discovery engine. This is based on the same principles that Spotify uses to find music that you like, and Netflix uses to find films, and Amazon pushes you ideas based on books you've been reading. It's a relevance-based discovery engine. So what I did was I seeded it with the symbol for Under Armour, UAA, and I'm just showing you 2 of the 7 slices that come up. In the top slice, you see stocks like UAA. These are mid-cap apparel stocks with bearish earnings trends. And this is a great way to see what other stocks you should be avoiding in the apparel sector. Or if you sell short, here are some short sale candidates. So you have VFC, HBI, Ralph Lauren, and so forth. Now, if you wanted to swap into an apparel stock out of UAA, we're showing you potential swaps, which are, in the first three instances, apparel stocks with a bullish power gauge rating and similar market cap. So Skechers and Perry Ellis being two of them. If you look more closely, you see a cruise line and then another consumer discretionary name. The engine could only find three bullish apparel stocks that matched up to Under Armour. This is a really powerful idea-generating engine. At the bottom, it also shows you ETFs that own the stock, so particularly focused on smaller population ETFs where it could have a negative impact. So this is the newest piece of intellectual property that we bundled into Chaikin Analytics, and we're very excited about this. The response has been fabulous for people who are looking for new stock ideas. Now, one testimonial to end the presentation. Many of you are familiar with John Malden, and in fact, if you are, type a big M in the question box, the Q&A box. John has 2 free market letters. He's a macroeconomic guru. He's on CNBC. He has a big global investment conference every year that people pay tens of thousands of dollars for. And John also has a newsletter business. So he had his team do due diligence on Chaikin Analytics and the power gauge rating for almost a year. And he gave us this testimonial. I'm impressed by what Marc has done. My analysts are enthusiastic users of Chaikin Analytics, use it to analyze the trades and recommendations of our writing team. Marc's system has been integrated into our routine due diligence process for vetting and evaluating potential investments. So high praise from someone with high standing in the RIA community. So we'd like to encourage you, those of you who are not already subscribers, and I know that there are a number of you who are on the webinar, Chaikin Analytics for iPad and desktop normally sells for $1,950 a year. As a special for this RIA webinar, we're reducing the price to $1,650. Now, along with that comes onboarding classes so you know what's in the system and how to use it. If you need a one-on-one session, we can do that. You also get my weekly market letter, which comes out on Sunday, where I've been analyzing sector and group trends for over 3.5 years. And my colleague John Schlitz's morning market commentary before the opening for those of you who are more actively focused on the market. John used to be at Lehman Brothers before it blew up. I hired him in the mid-90s at Instinet, where we had sold a company, and John is now with us writing a very, very solid technical and market morning recap before the opening. So all this comes for that annual price of $1,650. Now, if you have additional questions, I know we've got a lot of them to answer, and Stephanie's going to start reading them off. You can submit them in the Q&A box, but the website is chaikinanalytics.com/RIA. This offer is good until midnight Saturday, March 4th, or you can contact our sales department at 877-697-6783. At this point, I'd like to thank Stephanie, Julie at RIA Database for organizing this webinar. It's been a great turnout. We're absolutely thrilled. I hope we've delivered on our promise to show you how to use ETFs and individual stocks within ETFs to generate alpha through client asset allocation. And with that, Stephanie, I'll turn it over to you, and I'm ready to take any questions that come my way.
Wonderful. Thanks, Marc. Great job. Again, thanks, everyone. As a reminder, you can go ahead and type those questions in the box to the right of the slides. Again, as another reminder, there will be a replay available of this webcast. You'll all receive replay information by email within 24 hours. So let's get to those questions. The first question, would you consider, Marc, would you consider yourself a value investor or a momentum investor?
That's a good question. The power gauge rating, as I said earlier, is an eclectic rating. It can rate a value stock like Berkshire Hathaway as bullish. Right now it's turned neutral recently, and some of the financials, but can also find very strong momentum stocks to like. So it's an eclectic model. It's not religious. It doesn't only find one way to like stocks. It doesn't just buy value or growth or GARP. It finds a lot of different ways to like stocks. So I'm basically a go with the flow kind of guy. If the market is favoring small caps, then I want to find the best small cap stocks in the Chaikin Power Gauge methodology. If it's favoring financials and I want large cap exposure, I'm going to look at the XLF, find the best stocks in the XLF. Some of them may have value components that are positive. For, as I mentioned, when Goldman Sachs first saw its rating turn bullish, it was selling at or under book value. That's obviously a value investor. It's one of the factors in the model. As Goldman has moved up, it's become more of a momentum stock. So when the rating turned positive in October, late September, you could have said that Goldman was a value stock. Same thing with Berkshire Hathaway. Berkshire Hathaway got down to 1.1 times book value back in December of 2015. Warren Buffett at that point said, I'll buy back my stock at 1 times book value. That basically put a floor under Berkshire. The stock was trading at about 138. And it's trading now, I think, at 170. So the power gauge rating is really the guide, and it can like value or growth or momentum stocks equally as well.
Great. Let's see. Is this strictly a monitoring system, or is this a discretionary/managed account process?
It's both, actually. It's a way to monitor your client holdings. You can create a list for every one of your clients' holdings by downloading a CSV file. We're integrated into the TD Ameritrade VO platform and the Pershing Advisor platform, in which case your clients' portfolios update automatically. We don't see the actual holding weights, but we see the names, and that gives you the ability to use some of our other tools like our portfolio health check to monitor client portfolios, but also using the bottom-up approach of the power gauge rating and the technicals, you can create dynamic portfolios that have the ability to outperform the market. And using the top-down sector approach, you can be very proactive and effective with a unique approach to find the sectors that are likely to outperform the market. So the answer is both. You can monitor and you can create using Chaikin Analytics.
Great. Are these indicators better for short-term trading using daily charts, or can they be used for longer-term trading and weekly charts?
That is something that we accomplish in 2 ways. You can look at the daily chart and get longer-term information, but we do have a 5-year weekly chart that my colleague John Schlitz looks at religiously before he picks a stock for his daily stock of the day. And what he looks for are breakout patterns from the base, long-term trend lines being violated to the upside or the downside. And so the answer is that the power gauge rating has predictive value, as I said, 3 to 6 months out. And now with the NASDAQ indices, we've proven that there's staying power 12 months out since all the indices are outperforming. But if you have the time and you're an active manager, you should be looking at both the daily and the weekly chart. We make it very easy. You press a button, there's the 5-year weekly chart. You can just visually see what's going on. And then the daily chart is sort of my go-to chart because that gives me a sense of the rhythm of the stock. And I know for a lot of our advisor clients who are active managers, entry timing is very important. And there's one pattern that we didn't get into on this webinar that we call the Chaikin Money Flow Sell Alert. We put out an alert on 5 semiconductor stocks 3 weeks ago that had bearish Chaikin money flow as they were making new highs. 3 of those 5 stocks have dropped dramatically: Cirrus, Intel, and Synopsys. 2 of them have continued higher after a pullback, AMAT and one other name. But you can find shorter-term patterns that can help you exit stocks at new highs with negative money flow, and that's a pattern we've been teaching institutional investors for over 30 years. It really does work because it tells you that the institutions are selling under the cover of strength in the stock. It's typically the public buying in response to an earnings report. Institutions love to take advantage of that, particularly when a stock has had a big run. So a lot of ways you can use Chaikin Analytics, and that's what our customer success department is all about. We have 3 people dedicated to your success, 4 now, who work with you to help you integrate Chaikin into your daily workflow.
Wonderful. Can you talk about, regarding the S&P sectors, XLF, XLK, et cetera, what set of simple rules would keep you long a sector, when to get in and when to get out?
So what I like to do is to look first at the power bar. Technology, financials have been consistently in the top 3 for the last 6 to 7 months. I then go to the price chart or that sector graph where you can rank sectors, ETFs, indices by price performance in any one of 6 time frameworks from 1 week, or from 1 day actually, all the way to 1 year. So what I like to see is a combination of potential, that's the power bar, how many of the individual constituents in an ETF have bullish potential, and then the technicals. So the financials are a good case in point. The power bar on the financials was bullish all through the first 6 months of 2016, meaning there were more stocks with bullish than bearish power gauge ratings. Part of that is because the value metrics were strong. They were selling close to book value. They were generating free cash flow. But the technicals were not in place. So what keeps me long a sector ETF or any ETF is A, if the power bar is positive, and B, if it continues to outperform the market. If I see money flow coming out of it, because we can measure the institutional buying and selling, there was an article in Barron's just this Sunday that hedge funds use sector ETFs to make asset allocation decisions, easier than picking stocks. And so you can measure the institutional flow in and out of ETFs just as you can in stocks. So what would get me out of a sector is if money flow starts coming out of it and it starts to underperform the market. Not meant to catch tops and bottoms, meant to tell you when trends are changing. So for instance, if we were looking at biotechs, recently the biotech ETF, the IBB, has started to move up, starting to outperform the market. That would encourage me to want to get long. I'm going to want to try and stay long for the duration that it's outperforming the market and price action is confirming the power bar. That's another thing to realize. If you buy the healthcare ETF, select spider sector ETF, you're not getting a lot of exposure to biotech and drug stocks. You're getting the big drug stocks or the big healthcare stocks. So you've got to know what are in these ETFs that are driving them. As the example of Procter & Gamble driving the XLP, if Procter & Gamble starts to pull back because the activist investor is not really making a difference, the XLP on its own weight will start dropping. If interest rates start to rise, it'll drop even more. So it's very important to know what's in these ETFs. But if you want to know nothing and still do a good job for your clients, look at the power bar and look at the relative strength and money flow, and then hopefully by the end of May we'll have our synthesized fundamental technical power gauge rating for ETFs, which will basically make your life even easier.
Great. How do you pick one ETF over another ETF within the same asset class and the same constituent holdings?
I'm looking at expense ratios, so we show you in the bottom right of our ETF screening page the expense ratio, the liquidity. I think liquidity is really important. Sometimes it's hidden liquidity, but usually you can tell just from the volume. So I want a liquid ETF. I want it to have a low expense ratio, and I would like the names in there to be predominantly have bullish power gauge ratings. So 3 things that I look at in addition to the price pattern of the ETF itself. But all things being equal, obviously, you want to go to your client's best interests and look for low expense ratios, but you also want to find the best performing ETFs. And you do that by looking at the power bar and then clicking and looking at the chart to confirm that the ETF is in fact performing well and that the power bars are working.
Wonderful. I think we have time for one last question. When to invest new money, and does it matter?
Well, it always matters. I've been around 50 years, and none of us like to buy something and then watch it drop 5%. This has been a tough market. As we all know, we're up over 2,100 on the Dow. There have been a lot of naysayers. You have to pick and choose. So within the strong financial sectors, there have been pullbacks over the last month. You've had stocks like JP Morgan and Goldman Sachs have selling pressure on a short-term basis. Ideally, that's when I want to put money to work. If you're allocating new money, let's say you've gotten in an account from Merrill Lynch, you're at Ameriprise, and you want to know what to do with it, well, we do two things for you. A, you can run that portfolio through our portfolio health check. You don't have to just blanketly sell everything in there. You can look at the ETFs through our ETF screener to see if they've got a good power bar. But ultimately, money management and risk management are your game, not mine. You've got to decide what works best for your clients, for your style of managing money. In general, the reason I started with some history about the market is if you're always looking for a bear market, you're going to be underinvested and missing out. If you're looking for a correction and ready to take advantage of it, that's obviously a good place to put new money to work. But you don't always get the luxury of that, as we've seen over the last 5 weeks. The market has basically gone sideways, and now it's broken out to new highs. You have to have a sense of the market. We try and give you that in our weekly market letter based on the 3 or 4 indicators that we've used over the last 5 years that are proprietary to give us a feel and a sense of where the market's headed. But, you know, this is a tricky question, and it's a good question to end the seminar with, webinar. Market timing is a two-edged sword. I was a market timer for over 35 years, ran an options department, used market timing. When it works, it's great, and when it doesn't, you're sitting there on the outside wishing you were in. And we all know the statistics that say if you have perfect timing in terms of getting out, but you miss getting back into the market, it's those 10 or 20 days that you missed waiting for some confidence and conviction to get back in that undo all of the good you did by getting out of the market. So market timing is just a small piece of what we do in our market letter. And I would say that, you know, don't chase big spikes after an earnings report, but if a stock is settled down and you like it fundamentally, like a Radiant Research, perfect example, RDN. It's had 2 pullbacks in the last 6 weeks where you could have bought the stock on a 5% pullback. Earnings are going up. Their mortgage delinquency rates are going down. Big, smart investor like Doug Cass likes it. You can find opportunities where you don't have to be paying up for stocks to take advantage of a market that looks like it wants to keep working its way higher.
Wonderful. I think, Marc, at this point, we'd love to thank everyone for joining us today. Thank you first, Marc. Wonderful presentation. We've had a lot of really amazing feedback from the audience already. And as a reminder to everyone, there will be a replay. You can use the same link in case anyone wants to do a recap of what they've watched or if they missed any part of this. And with that, I'll say thank you to Marc and thank you to our audience, and have a wonderful day.
Well, thank you, Stephanie. And just a shameless promotion, if you take advantage of this $1,650 offer, you can be in one of our onboarding sessions tomorrow afternoon at 2 o'clock. We run them every afternoon at 2 o'clock because we're here for you and believe in client success and customer support. So again, Stephanie, thank you very much to everybody at RIA Database. This has been a great experience. You people are real pros, and I thank you.
Thank you. Bye-bye.